Here's the question. Is it better to invest solo, all by yourself, you doing everything, or invest with a group of people and get better returns potentially? Or the question is, which one will give you the better returns? So that's the question that I want to answer. And spoiler, somewhere in there, you're going to hear me go on a big rant on people who invest all by themselves, because a lot of them make a big mistake. It drives me crazy. It's a pet peeve of mine. We're going to get into it this week on the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our goal is to equip people to invest wisely, whether that's all by yourself or in a group, so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
Well, before you're a party pooper on being alone,
Okay.
I've got, our kids, one of our kids' birthdays is just coming up. It's exciting. And they're like collaborating.
Really?
Yes. Speaking of investing together, somewhere along the way, I thought it was a good idea to allow one of our kids to do a shopping spree for their birthday.
Yeah.
In lieu of a party, which then turned into a party. So I don't know how they convinced me of that. But now both of them are like, we both want a shopping spree and a party.
Dang.
And I was like, okay, like combined, like a big thing, or is this like
individually,
solo?
of course.
I like, oh my gosh, I'm just like, this is blowing up on me.
Man, that happens.
I gotta set some boundaries.
Yeah, well, gotta figure that out.
I'm like, are you sure you don't want to be alone? Let's just have I'll take you out to dinner. This will be good.
Yeah, that's fair. That's fair. Yeah, not gonna happen.
Not gonna happen.
But yeah, oftentimes it is a question, right? Is it better off to be alone or to be with a group of friends? And so there's those two paths, right? You got the solo investing, right? That's where you're going to find it. You're going to analyze it. You're going to fund it. You're going to manage it. You carry all the risk, and you also get all the upside for it. And then you have the other path, right? Path B, where you partner with an experienced investor like myself, and you are providing either equity or debt in that. So you bring the money, and someone like myself brings the expertise and the systems and the deal flow, the execution, all that other stuff. And so you have a lot less control, but you get more leverage. And so the question is, which one's better? Just from a pure return standpoint, on average, because every deal is indeed different.
Sure.
And so I want to start out talking about the solo investor, right? Full stack, full risk, full return.
Yeah.
Right? That person.
It seems like that would be the better way to go.
Why do you think that?
Well, because you're not sharing with anybody.
Oh, yeah.
I mean, perhaps if you are the only one providing funds, you get a smaller pie.
Oh.
But you get the whole thing.
You get the whole pie, but the pie is smaller. Get a little cupcake.
Maybe it's not as great, but
Maybe.
I don't know. You don't have to deal with other people and their wants and needs and complaints and everything else.
Yeah. Okay. Yeah, that's true. Those are benefits. From a pure number standpoint, I was looking up some averages, and it tends to be, I don't actually fully agree with these numbers, that tends to be in the 8 to 12% range.
Interesting.
Of people who are like purposely investing on their own.
Okay.
Okay.
Not like accidental.
Correct.
I stumbled upon this.
Yeah. Or it's just like, hey, I'm just a guy. I moved and I decided to keep this place. Or I saw a good deal, so I went for it. Like,
you're like intentionally investing in things.
Right. I think that's where they get those numbers from. It's hard to tell, man. The internet, you know how that is. And part of it is your cash on cash might be in like that 10% range. Appreciation might be in the 2 to 4% range. Somewhere in there, things kind of go up and down. Depends on if you have big repairs or not. You know, it all kind of depends. So that's kind of how those from the solo standpoint. Now, here's the reality. Okay, and this is my rant early on, is that there are a lot of first-time solo investors who they overpay for deals. Drives me bananas, because I will have people come to me and say, hey, I'm interested in investing. Can you help me analyze this deal? And I'll look at it and be like, yeah, I wouldn't buy this in a million years. Like, it's a bad deal. And then they buy it. I'm just like, what the heck? And usually what they'll say is like, and it's usually either like break-even cash flow, which when you think about like, and that's like not paying for a manager or accounting for long-term expenses.
You're assuming you're doing all of that.
Yeah. Or just like, again, they're just like ignoring the maintenance side of it. And so they're really like, they're feeding into it.
Yeah.
And usually what they'll say is like, it's fine. I'm just investing for retirement. In 30 years, this will be amazing. I have heard so many people tell me that. I'm just like, okay, I hear you, but a bad investment doesn't magically become a good investment in 30 years.
Yeah, that makes no sense to me.
Well, what happens is they're banking on appreciation.
Well, yes, but does appreciation outweigh like your maintenance costs going up, the fact that you're going to have to hire a property manager because in 30 years you can't actually manage it?
I mean, like it can, but depending on where you live.
Seems like too big of a gamble.
But for me, it's like the opportunity cost of it, right? It's like, I don't know. I've talked to, here's my.
Yeah, that's true. You put it in and then you wait 30 years. Like you could have been putting your money elsewhere for 30 years.
I've talked to people where they're like, they'll talk about their home investment. And I try to be polite about it, but they'll be like, yeah, I bought this house. My mom, is usually how it works. My parents, they bought this house 30 years ago and it's doubled in value. Such a good investment, right? And they'll even be like, they bought it for like $500,000 and now it's worth $1 million. Like, yeah, but over 30 years, like that's a horrible investment. Are you kidding me? I was like, dude, put that $500,000 in the stock market. But I get it. You got to live somewhere, whatever. But I'm like, you could have rented. And even with rent increases, putting that money in the stock market, you would have so much more than you do now. Again, I try not to be a jerk about it and just kind of like, nah, I'll let it go. But
there's other requirements of investing in real estate. And if you just buy a house, they're not there. It's easy.
Yeah, and oftentimes that's where they'll tell me like they bought a house that they're living in and they'll talk about how good of an investment it was because it's gone up. I'm like, dude, it was just market appreciation. Like that's not from a skill standpoint, there was none there. Again, there's a pet peeve of mine, and I usually do a good job of keeping it inside. I'm like, yeah, from a pure investment standpoint, no, it wasn't a good deal. Again, you got to live somewhere. Cool, that's awesome. Sure. But it's when people approach me and say, hey, I want to go off on my own. Help me analyze this deal. That's where I'm like, dude, like the numbers, like be picky. Yeah, it's okay. Like, but they go, no, it's okay if it's break even because in a few years rents will go up and it won't be break even anymore. Like, yeah, I know, but imagine if you waited around and negotiated better and got a great deal. Rents will still go up. Appreciation will still happen. It's just now your leverage is even more. Anyways, so my issue is most first-time solo investors, they just overpay. It's really hard. Like we took 18 months to find our first place because we were sticklers about making sure that it was a good investment.
You're welcome.
Yeah, and so I think that's just an important piece to remember. But in theory, for people who have done it multiple times, you get in that 8 to 12% range return. So let's talk about the other side of it. Partnering with an experienced investor like myself who has that kind of pet peeve and therefore only does good deals. And so usually investment, you can do you can invest in a syndication. You can do equity, right? And that's where it is a syndication or a joint venture, something like that. Oftentimes you can get like a preferred return of 6 to 8%. There's an IRR target of 12 to 18% over 3 to 7 years. And like an equity multiple of like 1x to 2x your money. It's one of those where it's slightly better. It's not amazing. That's actually the other issue with a lot of the solo investing. Like they don't actually calculate an IRR number. They don't know how to do it. So they go, yeah, I made 20%. Cool. Over what time frame? Then when you discount it, you go, oh, this was 8%, something like that. So anyways, those tend to be the typical returns. Now, big benefits of that one is like you're leveraging someone else's time and expertise. You can often go after bigger projects where the math for creating value is a lot more straightforward. Huge drawback, a lot less control. Yeah. Right? That's a big one. And oftentimes there can be a pretty high minimum bar. But it depends, right? Like in some houses, you actually got to do like a down payment of like 90 grand to get in, whereas this might only be 50, which is nice. So it could be lower, but it's still, if you're comparing it to like an FHA loan for your first house, 50,000 is significantly more than what you're looking for. So pluses and minuses. You don't get to say when to sell. Right. You're really beholden to someone else. That's important. The other thing that you can do for investing with people is by lending money, being a private money lender. Now, the nice part about that one is it's highly predictable, but you don't get to participate in that upside. And so it's kind of that balance, right? It's a fixed return. So essentially, you get to be the bank,
Yeah.
which, it's kind of cool
Sure.
as well.
In
And
some
so-
ways, there's less risk. And
Yes, in a lot of ways, there's less risk because your first money out typically,
Right. It's just
which
guaranteed
is nice. Yeah, so
interest
it's exactly like it sounds. You got someone like myself who's flipping a property, and you provide the funds to do that flip. And so your loan is secured not only by potentially a personal guarantee, but also by the property itself. And then they just pay you a fixed amount of interest, either as a lump sum at the end or monthly over
What's
time.
the typical range for that amount of return?
Yes, 8 to 12%. Shocker. They're actually all very similar.
Yeah.
But this one's a guaranteed. Like we pay
Right.
12%. And so, that's what it could be. And so, but again, like you get rid of a lot of volatility for that. One interesting thing about it is that now you're no longer just looking at the deal necessarily. You're also looking at the borrower and saying like, hey, what are the chances that you think they'll perform? Like I've got a friend who's probably listening right now. Hey there. And he is invested as a hard money lender, essentially, as a private money lender.
Yeah.
And there's a few deals of his where like they get behind. And in one of them, he actually is foreclosing on the house.
Oh, interesting.
It's an investment. It's not like no one's getting kicked out of their house. But
Okay.
but it's kind of funny. He goes, man, in some ways, I actually make a lot more money when they stop paying because now I got this awesome collateral that it's backed by. But he's trying to balance out that like I do like that I made more, but that's just, there's that risk and there's the heartache and the stress of having to go through that whole process. Where he's like, man, you get people like myself. He's like, man, I know it. Like, it's a return. Whatever you say the return is, that's what I'm going to get. I'm like, well, yeah, because I just guarantee that I will. If I have to pull funds from somewhere else in order to pay, that will happen. And so there's just try that balance there. You gotta feel that out.
Are there limits to the amounts that you can lend?
No. What do you mean?
Well, like if I wanted to be a hard money lender in one of your deals,
Yeah. Private money lender. Please.
private money lender,
Whatever.
like, can I give you $1,000? Can I give you
Oh,
10?
on the downside of it. In theory, no. There's no downside limit. It could be $1, I guess.
I mean, that'd be a little weird because my return would not be
Great.
huge, but
See, my head went the other direction. Could you do $100 million?
Oh.
Answer yes. But yeah, no, in theory, it could be as low as you want.
it's kind of interesting.
You do, all the lenders get stacked in positions, right? You have first, second, third, fourth, fifth.
Makes sense.
Get to a point where you're like, all right, this is getting a little goofy. So you got to be careful there. Yeah.
Makes sense.
But yeah. So yeah, I don't know. That's just kind of a quick. At the end of the day, the answer is always it depends.
Yeah. So here's my big takeaway is like
Yeah.
each one of those scenarios that you presented, invest on your own, invest with a partner, or lend, which
Yeah.
kind of
I know it's kind of an A/B.
yeah.
The same coin.
Give you similar returns. So really it's not about the return necessarily. It's about the other factors and other costs involved.
Yeah.
Or perhaps different strategies that you're thinking through.
Yeah, and I think at the end of the day, like if you're gonna go out on your own, you still got to do a good job underwriting. You still got to be picky about the deal. Value add is probably still gonna be your best type of return, and that's the nice part about investing with an experienced person. Like they're gonna factor and optimize for all of that.
Yeah.
Whereas you, as a solo person, like you have to do all that, and then there's just the risk of your own time, right? I own a property management company, and I do talk with owners who, like, they have great intentions, but like, dude, I have a full-time job. I don't have time for this.
Yeah.
And they're just even like, just finding tenants is too much work. I'm like, all right, yeah, no, I totally get that. And so like, that's part of that factor, which now it's like, there's this other cost here, cost of time, which is a thing. And as a result, you tend to be like, yeah, I don't know, you just fall in love with the property, man, not the deal. And that's hard.
Interesting.
And so you do tend to overpay for our first time because you just don't know any better. And because like I've underwritten hundreds of deals at this point. I've looked at a lot. I know what good deals look like.
Yeah.
And I know how to structure things in such a way that they work. Whereas like, man, if you're trying to do it on your own, it's hard to think through all those things. And
eventually
Yeah.
you would get to that point.
yeah.
But-
I mean, yeah, I did, but yeah, you will.
Mm.
Yeah. So it's just harder. I think that 8 to 12% honestly is optimistic in terms of returns, just because I think there's so many other people out there who like they're accidental or whatever. They're not as purposeful, or they just get lucky. You know, that's the other. They didn't.
If
purposely
you
go
were
find
interested
something.
in going out on your own,
Yeah.
would you recommend that someone kind of work with a partner first, do a few deals, and then maybe try some on your own? Or is that just like, no, you might as well keep investing with other people?
Yeah, usually it's the other way around, right? They're like, well, first
Right.
I'll do some on my own, and then once I've acquired some wealth,
Yeah, some
then
capital, I'll put it in.
invest with other people.
Huh.
It's like, yeah, you might actually think about doing it the opposite direction. Like, get on, see how it's done, ask a lot of questions,
Right.
see the underwriting models, and then decide, okay, I'm going to go off on my own and do stuff. That's probably a better way to approach it, just because you learn so much.
Right. Yeah, it makes
If you
sense.
ask, right? If you
you're-
never ask, if you just give the money and walk and like go, good luck, tell me how it works out. Like, yeah, you're not going to learn
Right.
anything.
But if you're wanting to learn and grow, like, it makes sense. Find an expert and
Yeah.
shadow them, figure it out.
Yeah. And I think in theory, if you do it on your own, the other issue too is just like, you just can't go after bigger deals. Like you're stuck in that small residential area for a long time
That's
because
true.
the capital amounts so much. And it's harder. It's not impossible, but it's just harder to get those returns. And so like, I talked to a lot of people where they're like, I got one guy in particular who he would love to buy, like to do a fix and flip. But he's also like, dang, that's a lot of money. Cause I'm like, yeah, cause you got to pay cash for this thing.
Yeah.
He's like, I don't have that kind of money. Like, and you can't do that kind of deal.
Yeah.
Whereas like for me, because I'm pooling the funds, I'm like, yes, I can. And I do. And like we're looking at a property right now. It's a piece of land actually. And we'll probably talk more about this in another podcast. But we're going to like build a house on it.
Yeah.
It's like, cause we can. And cause we've got the funds from pooling it to go off and do it. Whereas like a solo person, man,
Right. That's a big ask.
That's super hard.
Yeah.
And like official, like hard money lenders, like lender type folks.
Yeah.
They don't like giving money to them. Cause like, you don't have any experience. You don't know what you're doing. Like that's a lot of risk.
Yep.
You know, whereas like someone like me, like, oh yeah, no, we get you. Like you've done this, you've proven yourself. So you're fine. We'll like, yeah. So I've access to capital markets that other people don't just because of my experience.
Interesting.
But yeah, there you go. There you go. I feel like I wanted kind of a tighter conclusion on that, but that's okay. That's the nature of the game, I
And
guess.
therefore, you should invest with Furlo Capital.
Yeah, there you go. Because your returns will be better, your stress will be less,
You won't be
your
alone.
risk is a different profile. Yeah. Oh man, sure. There you go. I don't know. Love it. Awesome. Well, what I do know is that I would love to invest with you. And if you are interested in learning more about us and our investment thesis and that amazing track record that I alluded to, you can check us out at furlo.com. And so, yeah, we would love to connect and learn more about your goals and how we can partner together to help you reach those. Thanks for watching, listening, and interpreting. I don't know, I feel like I needed a triple there. Anyways, have a great day.